This is a very active time in the market, I don't have to tell you. But this week, the VIX crossed 65, which is the fourth largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's fourth after 08, 09, the tech and telecom bubble in 2000, and 1987.
The recent global stock market, which swiftly spread through other markets, including the cryptocurrency market, still has investors and traders concerned and shaken about the trajectory of the US and global economy. Despite the past few days' rebound, the fears about the markets have not been helped by legendary investors like Warren Buffett, who have been increasing their cash pile at the highest pace since just before the global financial crisis in 2007. Warren Buffett's Nebraska-based conglomerate, Berkshire Hathaway, has reduced several stock positions and slashed its stake in Apple, its top stock holding, which investors and traders are taking as a sign that Buffett is bracing for a bigger crisis in the coming months. At a record $276.9 billion, Berkshire's cash and equivalents as a proportion of its total assets are now back to their previous highs from the early 2000s, just before the great financial crisis, which saw the iconic investor scoop up a lot of investments at ridiculously low prices. In a recent video update, ARK Invest founder, CIO and CEO Cathie Wood explains that the recent crash might be a precursor to a bigger crisis, one that could easily rival the 08-09 crisis in both severity and duration. According to Cathie, what is happening at the moment can be described as a complete purge, as the market is coming to terms with recent events and moving things around to suit the new environment. Cathie is firmly convinced that the purge is nowhere near complete, and there's still so much more to brace for. As we bring you clips from Cathie's video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing. And as you know, we have believed for quite some time that the U.S. economy and maybe the global economy has been going through a rolling recession ever since the Fed started raising interest rates. Well, the other thing that was happening during that time, apparently, was an increase in the carry trade involving borrowing yen, so really shorting yen, and buying dollars and investing them into higher yielding assets than in Japan, so playing the spread. The other reason this became a very widespread trade is the yen has been depreciating. So shorting yen meant that the investor or the speculator was benefiting from the yen going down. Well, that changed abruptly this week as the Bank of Japan increased rates more than expected and seemed more determined to continue increasing rates than many people expected. So apparently, lots of margin calls and a sell-off in a lot of assets. And now the VIX has calmed down. Now, we're not sure if the carry trade has unwound completely. JP Morgan is saying we're halfway there. So perhaps we'll see some more volatility, but I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding, much faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens. Now, why is the consumer going to weaken or continue weakening? We believe it's because corporations are losing pricing power. And in order to salvage margins, they're going to be doing two things. They will be laying people off, and they will be accelerating moves to increase productivity. So the unemployment rate will go up. That certainly is getting the Fed to change its spots, as we're listening to Chairman Powell. And I think now that household net worth being hurt by the stock market going down is another reason that the Fed is going to relent. Now, one last thought here. Interest rates coming down should be a very positive for the equity markets, but they will not arrest a recession very quickly. In fact, if consumers and businesses know that interest rates and maybe prices are coming down, what will they do? They will wait.
Cathie believes the crash will completely change investors' behavior and reliance on current benchmarks. At the moment, the Magnificent Seven pretty much dominate the stock markets, and during moments of trouble such as this, investors turn to them for succor and assurance. Cathie's Florida-based investment management firm, ARK Invest, has been making a huge bet on disruptive innovation since it was founded in 2014. Cathie believes these technologies, artificial intelligence, DNA sequencing, CRISPR gene editing, robotics, electric vehicles, energy storage, fintech, 3D printing, and blockchain technology will gradually begin to replace the current benchmarks. This is why Cathie is betting so much on these technologies, predicting they will grow exponentially, from less than $20 trillion today to over $200 trillion by 2030. In stark contrast to Cathie's less optimistic near-term predictions, Fundstrat's Tom Lee believes the worst of the stock market scare is over. Earlier this week, Lee pointed out that the CBOE Volatility Index, which made history when it soared a record 172% on Monday, is now cooling, suggesting that the bottom is in for the stock market. Lee repeats similar sentiments in a recent interview with CNBC Television, explaining that the recent crash was caused by the markets grappling with the threats of war, red flags, in the US labor market, and the unexpected unwinding of the Japanese carry trade. Lee believes each of these threats is correctly being handled, and the market is moving on to other more positive issues. Here are some clips from the interview.
The thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind, but I think the worst of the selling pressure is behind us. Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday, and a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds, and next Thursday they'll get another weekly claims number, and if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade?
Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade. But if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or last week, the end of last week, that's very disorderly, and that gets very expensive because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that is been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if we're staying in stable and predictable ranges, it can be a orderly unwind. But yeah, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Cathie and Lee have presented opposing views about what's next for the markets. While Cathie envisions some more turbulence for the US and global economy, especially in the mid to near term, Lee, who's more focused on the short term, believes the worst is over and that the recent bounce will continue for much longer. However, Lee does not discount the possibility of more turbulence if other issues crop up later. These issues include signs of more weakening in the US labor market, an escalation of the war in the Middle East, or other issues that can send the markets into an immediate spin, much like what we witnessed late last week and on Monday. Please share your comments and observations on Cathie's and Tom's interviews in the comments section below, as well as your own assessment of the current market situation. Do you agree with Cathie that there's more to come, or Lee's analysis that a bigger unraveling of the market can simply not be allowed to happen? If you like this video, please share it with others, smash the like button, click the subscribe button, and turn on post notifications for more videos. You can also check out our other videos, featuring insightful analysis and important predictions from some of the industry's brightest minds. We appreciate the support and hope to see you in the next one. Thanks for watching.